Welcome to Crisis in Perception, where we examine the systems shaping our world.
Glad to be here.
We spend a lot of time on this show talking about things that are, well, things that are visibly broken, right? We talk about crumbling bridges or healthcare waiting rooms that are overflowing or the power grid just completely going down during a storm.
Right, the loud failures.
Exactly, the loud failures, things where the failure is just obvious. It's right in your face. But today, we are looking at a system that, for a certain segment of the population, probably a lot of people listening right now, honestly, it seems to work perfectly fine. It's seamless, it's digital, it's basically invisible.
I'm talking about the American banking system.
I am, yeah,
Mhm.
because, if I want to buy a coffee, I just tap my phone. If I want to buy a house, I sign a mountain of paperwork, sure, but the money just sort of magically appears. And if I want to save for a rainy day, I have this federally insured account that costs me absolutely nothing. In fact, they actually pay me a little bit of interest to keep my money there.
Which is, that is the experience of the banked, the fully banked.
Right, the banked. But today we're really digging into the reality that this seamless, frictionless experience is actually, it's a walled garden. And outside that wall, there is a completely different reality for millions of Americans.
Yeah.
A reality that is incredibly expensive, predatory, and just fragile.
Yeah, we are dissecting the architecture of inequality within the banking system today. And to do that, our primary source material for this deep dive is going to be Mehrsa Baradaran's book, How the Other Half Banks: Exclusion, Exploitation, and the Threat to Democracy.
And I have to be completely honest here. Before reading this material, my assumption about banking inequality was pretty standard, I think. I just thought, well, banks are businesses, you know? They're like a grocery store or a car dealership. If you have money, you get the nice car. If you don't, you take the bus. It's just the free market doing its thing.
Which is the dominant narrative. That is exactly the perception we are going to challenge and dismantle today.
Because Baradaran's central argument is that this isn't a free market outcome at all, is it?
Not even close. The mission of this deep dive is to really show that banking inequality, the fact that the poor literally pay more for money than the rich do, is a product of specific, deliberate design choices. It is the result of a state-sponsored architecture that completely prioritizes one group while actively extracting wealth from the other.
And to really understand the stakes here, I don't think we should start with the Federal Reserve or, complex regulations. We should start with two people, or actually one real person and one metaphor that the book uses.
Tanya and Stephen.
Exactly. Let's start with Tanya, because this is a story from the text that I think everyone needs to hear. It illustrates just how incredibly thin the margin for error is in this country. So Tanya Burke is a single mother living in North Carolina. She's working as a secretary, and she's earning about $11 an hour.
Which, let's be clear, $11 an hour is not enough to build any sort of robust savings account. But she is working full-time. She is doing everything that society tells her she is supposed to do to be responsible.
Right. She's playing by the rules. But she's still living paycheck to paycheck, which is the reality for nearly half the country.
Yeah.
And then life happens. Her 8-month-old son needs intestinal surgery.
A massive medical emergency.
Yeah. And the surgery itself is actually covered by Medicaid or insurance, thankfully. But Tanya has to take time off work to care for him during the recovery. And of course, she doesn't have paid family leave. So her income completely dips for that month. And suddenly, she is $500 short on her rent and utilities.
$500.
That's it. That is the cliff edge for her. $500. Now, I want to pause there because if I'm $500 short, I just put it on a credit card. I pay maybe 15 or 20% interest, and I pay it off over the next month or two. It's an annoyance. It is not a life-destroying catastrophe.
Or you dip into a savings account, or you simply get a small personal loan from your bank. You have options because you have access to liquidity.
Exactly. But Tanya walks into a mainstream bank, and they look at her credit score. They look at her income volatility, the fact that she just missed a couple weeks of work, and they say no. The door is closed to her. She cannot borrow $500 from the mainstream subsidized banking system.
She is illiquid. And this is a crucial economic concept we really need to nail down early in this deep dive. Illiquidity means you have assets, maybe you have a job, a car, future income earning potential, but you have no cash right now in this exact moment. You're fundamentally stuck.
So because the mainstream bank says no, she has to go to the only place that says yes, which is a payday lender.
The neon sign in the strip mall, fast cash, no credit check, we've all seen them.
Right. So she borrows $600 to cover her bills and have a little buffer. And the fee is something like $90 for a 2-week loan, which, if you're desperate and your kid is recovering from surgery, $90 sounds totally manageable. But the catch is the timeline. 2 weeks later, she hasn't magically caught up on everything. She's still in the financial hole. So she can't pay the full 600 principal plus the $90 fee.
So she rolls it over.
She pays a fee just to extend the loan. She doesn't touch the principal. And then 2 weeks later, she does it again and again. Over the course of a year, Tanya ends up taking out something like 8 distinct loans. For that initial $500 shortfall, she ends up paying over $2,000 in fees and interest.
She paid a poverty premium. The system basically charged her a massive punitive tax simply for being poor and illiquid.
Now, I want everyone listening to hold that image. Tanya, spiraling into $2,000 of debt over a $500 medical shortfall. Now let's look at Stephen.
Stephen is the perfect counter-narrative here. In the source material, Stephen is used as a metaphor for the major U.S. banks during the 2008 financial crisis. So think of Citigroup, think of Bank of America, think of all the giants.
Okay, so paint the picture of Stephen in 2008.
Stephen is standing on the absolute edge of a cliff. Stephen has been gambling. And he hasn't been betting on necessary intestinal surgery for his kid. He's been betting on incredibly toxic subprime mortgage derivatives. He has leveraged himself to the hilt, placing massive bets with borrowed money.
He bet the house, the car, the neighbors' houses, the whole block.
And he lost. The housing market crashed. And here is the key difference. Stephen isn't just illiquid, like Tanya. Stephen is insolvent. His liabilities massively exceed his assets. By every rule of capitalism, by every single rule of the free market that these exact bankers love to preach about in editorials, Stephen should be liquidated. He should be completely out of business.
Because that's the creative destruction of the market, right? So you make terrible decisions, you fail. A shoe store that sells shoes nobody wants goes out of business.
Theoretically, yes. That is how it is supposed to work. But Stephen has a superpower that Tanya does not have. Stephen picks up the phone, and he calls a lender that doesn't operate like a normal bank. He calls the Federal Reserve.
The rich uncle.
The ultimate rich uncle with a printing press. And Stephen essentially says, look, I know I'm broke. I know I'm a terrible credit risk right now. But I'm Stephen. If I go down, the entire global financial neighborhood burns down with me.
It's a hostage situation.
It is entirely hostage situation.
Yeah.
And because of that systemic leverage, the Fed opens up what they call the discount window, which is just a polite bureaucratic term for a fire hose of cash. We are talking billions and billions of dollars wired overnight at interest rates so low they are effectively free.
We're talking, what, near 0%?
Often very close to it, especially during a crisis. Imagine if Tanya could have borrowed that $500 at 0.5% interest.
She would have paid it back in a month. She would have been completely fine. It wouldn't have even been a blip on her radar.
But Tanya doesn't get the discount window. Only Stephen gets the discount window. And this brings us to the core thesis of Baradaran's work. The American system treats Stephen, the massive, risk-taking banks, with a robust safety net, a velvet glove, and endless public subsidies. But it treats Tanya, the working citizen, with the absolute unforgiving ruthlessness of the market.
Which is just a massive violation of the social contract.
Exactly. Why does the state move heaven and earth to save the banks, but actively allow those same banks to exploit the citizens? To understand that, we have to look at the foundational design of the system. We have to strip away the corporate branding and look at what an American bank actually is.
Because, again, my perception, and I think the perception of most people listening, is that I see a bank branch on the corner right next to a Starbucks or a grocery store. I assume they are the exact same kind of entity. Private companies, shareholders, a CEO, and a profit motive.
And that is the primary misconception right there. That is a massive crisis in perception. Baradaran argues that the U.S. banking system is actually a public-private hybrid.
A hybrid, what does that mean in practice?
It means you should think of banks not as independent, swashbuckling private corporations, but essentially as franchisees of the federal government. Yes, they're technically private companies, and yes, they have private shareholders who take the profits. But they sit on a massive, invisible foundation of state support. Without the government, the modern banking model simply cannot exist for a single day.
Okay, you need to break that down for us. Because I don't see the government writing checks to my local branch manager every morning. What does this public support actually look like?
It's structural. The book identifies 3 main pillars of this safety net, what Baradaran collectively calls the subsidy. The first one is something you literally see every time you walk into a branch. It's the gold sticker on the glass door. FDIC.
The Federal Deposit Insurance Corporation, insured by the full faith and credit of the United States government.
Exactly. We take that sticker completely for granted today. But think about what it actually does economically. If you lend $5,000 to your brother-in-law to start a business, you are worried. You watch him. You check if he's spending it on inventory or if he's blowing it at the casino. You police his behavior because you personally bear the risk of losing that money.
Right. If his business goes broke, my money's gone.
But when you deposit $5,000 in a bank, which is legally you lending the bank your money, do you ever check their balance sheet? Do you stay up at night worrying if they are investing in risky commercial real estate or weird derivatives in foreign markets?
Never. Not once. I sleep like a baby knowing my money is there.
And why is that?
Because I know that even if the bank completely mismanages everything and fails tomorrow, the government will give me my money back, up to $250,000.
Right. That government insurance completely removes the discipline of the free market. It creates what economists call moral hazard. Banks can take massive risks with your deposits, investing in high-yield, dangerous financial instruments to maximize their own profits, because they are completely protected from the consequences of losing your trust. The government, meaning the taxpayer, ultimately bears the risk of the depositor panicking.
So the government is basically acting as the ultimate cosigner for every single bank in America.
In a massive systemic way. That's pillar one. Pillar two is the Federal Reserve, specifically that lender of last resort function we just talked about with Stephen.
The discount window.
Right. Think about a normal business. If a Starbucks or a local hardware store runs out of cash, even just for a day or two, it bounces checks. Its suppliers cut it off. It gets sued. It goes bankrupt. If a bank runs out of cash, it doesn't bounce checks. It just quietly borrows from the Federal Reserve to bridge the gap. It has a permanent institutional lifeline that no other private industry on earth has. It guarantees their liquidity.
Which is just a huge competitive advantage. It's like playing a video game with infinite extra lives. You can afford to take crazier risks if you know you won't actually get a game over screen.
Precisely. And then there is the third pillar, which honestly might be the most powerful one for actual wealth creation and bank profitability. And that is the government-sponsored enterprises, or GSEs.
You're talking about Fannie Mae and Freddie Mac?
Yes. Now, this gets a little bit technical, but stick with me because it explains why you can actually get a 30-year fixed-rate mortgage in this country. In the old days, before these GSEs existed, if a bank lent you money to buy a house, they gave you the cash, and then they had to sit there and wait.
They had to wait for me to pay it back over 30 years.
Right. For 30 years, that money was tied up in your house. Yeah. The bank was illiquid. They couldn't take that same money and lend it to the next family who walked in the door. The whole system was incredibly slow.
It's a clog in the financial pipe.
Exactly. But with Fannie Mae and Freddie Mac, the government created a secondary market. Now, the bank lends you the money for the house, and almost immediately, sometimes within days, they turn around and sell that exact loan to Fannie Mae.
So the bank gets their cash back instantly?
Instantly. Plus, they make a little profit on the origination fees. And now they can take that exact same pool of cash and lend it to the next person, and then sell that loan and lend it again. It fundamentally turns the bank from a static vault into a high-speed pipeline. It allows them to lend exponentially more money than they actually have on deposit.
And Fannie Mae, which is buying all these loans, is backed by the government.
Implicitly, for decades, and after 2008, explicitly. So when you look at these three things working together, the FDIC insurance protecting deposits, the Fed's safety net guaranteeing liquidity, and the GSE secondary market turbocharging lending volume, you start to realize that the private bank is actually standing on top of a mountain of public infrastructure.
So when a CEO of a mega bank goes on television and starts talking about the virtues of the free market and complaining about getting government off their backs,
he is completely ignoring the foundation his entire business model is built on. If you took the government guarantees away, the modern mega banking model would collapse in 24 hours. There would be massive bank runs by Tuesday.
This is fascinating because it completely reframes the whole argument we always hear. It's not government versus business. It's a government-supported business operating for private gain. But I want to take a step back because how did we actually get here? The book goes way back into history, doesn't it? This hybrid system isn't just a modern invention from 2008. This tension is basically built into the DNA of the country.
Oh, it goes back to the very beginning. It is a classic American ideological battle. Alexander Hamilton versus Thomas Jefferson.
Okay, set the stage for us. We're in the late 1700s. The country is brand new.
Right. Alexander Hamilton is the first Treasury Secretary. He's the ultimate federalist. He looks across the ocean at England specifically, and he sees the Bank of England. He sees a centralized, powerful, heavily capitalized financial machine that is fueling an empire.
He wants America to be a superpower. He wants us to compete globally.
Exactly. Hamilton argues that if we want a world-class economy, we need efficiency. We need a strong, centralized national bank to coordinate credit, fund large-scale industrial projects, manage the currency, and handle the national debt. He basically wants Stephen. He wants the big, efficient, powerful machine.
And Jefferson, I imagine he sees things a bit differently.
Jefferson is absolutely horrified by Hamilton's vision. He looks at large centralized banks and he literally sees tyranny. He believes that if you centralize the power of credit in the hands of a few wealthy elites in Philadelphia or New York, they will inevitably use that power to screw over the little guy, the farmers, the rural communities, the tradesmen.
He thinks they'll just extract wealth from the countryside, pull it into the cities, and hoard it.
Precisely. Jefferson wants a fundamentally different architecture. He advocates for what we call unit banking. He wants a system where banks are incredibly small, fiercely local, and strictly tethered to their immediate geographic community. He wants the banker to look out his window and know the farmer he just lent money to.
So who won that fight? Because looking around today, it looks like Hamilton won in a landslide.
Well, looking around today, yes. But historically, for the first 200 years of American history, Jefferson actually won.
Really? 200 years?
Yes. We completely forget this now, but for most of American history, our banking system was deliberately designed to be inefficient. We had strict laws that prevented banks from branching out. In many states, a bank in one town legally could not open a branch in the next town over, let alone across state lines.
That seems absolutely insane today. That's like saying a local coffee shop in Chicago is legally banned from opening a second location in Detroit.
It was incredibly inefficient. And frankly, it caused a lot of instability. Because if a local economy crashed, say, the local crop failed in a farming town, the one local bank failed with it.
Right.
We had thousands of tiny banks failing all the time. But the political priority of the nation was access and local control. The government essentially decided, we would rather have thousands of slightly inefficient, fragile local banks that are forced to serve everyone in their geographic area than have a few hyper-efficient mega banks that only serve the most profitable slice of the population.
So the small-town banker like George Bailey from It's a Wonderful Life, that wasn't just a heartwarming movie trope. That was actually a rigid regulatory requirement.
That was the law. George Bailey couldn't be bought out by a Wall Street conglomerate. The bank had to live and die with the citizens of Bedford Falls.
So what happened? Because I look around my town now, and I certainly don't see the Bailey Brothers building and loan. I see Chase, I see Wells Fargo, I see Citibank. I see the exact same 4 corporate logos on every major intersection in America.
And that brings us to the next massive shift in the architecture, which is the section on incentives. The Hamiltonian vision finally took over.
When did the tide actually turn against the Jeffersonian model?
It really started cracking in the 1970s and 80s. The boring, heavily regulated local banking model started to fall apart for a few reasons. You had massive stagflation, you had new technologies emerging like ATMs and electronic ledgers, and you had fierce global competition from foreign banks that weren't held back by these local branching laws. So the argument shifted. Policymakers started saying, listen, we simply cannot afford this Jeffersonian inefficiency anymore. We need scale.
Enter the era of deregulation.
Exactly. And the real pivotal moment, the death blow to unit banking, was the Regal-Neal Act of 1994.
I feel like 99% of people have never heard of the Regal-Neal Act, but it sounds like it structurally changed the entire country.
It completely dismantled the geography of American banking. It finally allowed full interstate branching. Suddenly, a bank in North Carolina could merge with a bank in California. It unleashed this massive wave of consolidation. It birthed the era of the megabank.
And the logic behind this deregulation was basically just bigger is better, right?
It was the efficiency hypothesis. The prevailing economic idea is that huge banks benefit from economies of scale and economies of scope. If you are a massive institution, you can spread your massive technology costs, your cybersecurity infrastructure, your nationwide ATM networks, your mobile app development. You spread that over millions and millions of customers, so your cost per customer plummets. You can operate much cheaper than George Bailey ever could.
It's the Walmartization of banking. Squeeze the overhead costs down, offer lower prices, crush the small competitors.
Exactly. The supermarket model of financial services.
Okay, I have to play devil's advocate here for a second because as a consumer, I kind of like the Walmart model for my bank. I
Okay.
actually really like that I can go to an ATM in any city in the country and get my money. I love the frictionless mobile app. I like the 24/7 customer service. If big banks are mathematically more efficient, why is that a bad thing? How did this efficiency hurt, Tanya?
That is the crucial question to ask. Efficiency is fantastic for the people the bank actively wants to keep. But efficiency fundamentally changes how the bank decides who it wants to keep. It changed the very mechanism of lending. The shift went from using what the book calls soft data to using hard data.
I love this distinction in the source text. Break this down for us. What exactly is soft data?
To understand soft data, you have to picture a loan application in, say, 1950, under the old Jeffersonian model. You walk into a local bank, you sit across a physical desk from the branch manager. Now, he knows your family. He knows you go to the local church. He knows that, yes, you lost your job at the manufacturing plant last month, but he also saw you out painting fences and doing odd jobs the very next day to make ends meet.
He has context. He has the full, messy, three-dimensional picture of you as a human being.
That is soft data. It is entirely qualitative. It relies on relationship, community reputation, and character. It allows for human judgment calls. The local banker can look at your file and say, well, the raw numbers look bad right now, but I know this guy's character. I trust him to pay me back. I'll approve the loan.
And today, how does it work at a mega bank today?
Today, you don't sit across from a human being who has the power to override a system. You log onto a website, or you sit with a teller who is just staring at a screen. You type numbers into a form. That form doesn't know that you paint fences on the weekends. It doesn't know you're a dedicated parent. It only knows three things. Income, $11 an hour. Credit score, 580. Debt-to-income ratio, high.
It's purely binary. It's an algorithm outputting yes or no.
That is hard data. Now, hard data is incredibly mathematically efficient. It allows a mega bank to process 1 million loan applications in an hour. And more importantly, it allows them to bundle those standardized loans together and sell them to investors on Wall Street, which we talked about earlier, securitization. You cannot bundle and sell character. You can't sell George is a good guy to an institutional investor in Tokyo. You can only sell a standardized credit score of 720.
So when these banks got huge and went national, they absolutely had to standardize. And standardization inherently meant stripping out all the humanity and local context.
It meant stripping out the exact soft data that lower-income people rely on to prove their creditworthiness. Because the poor often have terrible-looking numbers, but incredible discipline and character. They have volatile, gig economy income, but high reliability. The algorithm physically cannot perceive that, so the algorithm just rejects Tanya automatically.
But it's not just the algorithm driving this exclusion, is it? It's also just straight up profit incentives regarding account maintenance.
Right, the math of the small account. This is the dark side of the efficiency coin. Think about the administrative overhead. It costs a bank roughly the exact same amount of money in fixed costs, the IT infrastructure, compliance tracking, mailing out statements, customer service routing, to maintain a checking account that has $500 in it as it does to maintain an account with $500,000 in it.
The fixed infrastructure costs are identical.
Identical. But the $500,000 account allows the bank to leverage that money, lend it out, and make huge returns. The $500 account, basically dead weight on the balance sheet. It literally costs the bank more money to keep it open than they can make off the deposits.
So if you are a massive profit-maximizing entity that is legally responsible only to delivering returns to your shareholders, what do you do with that $500 account?
You try to get rid of it, you push them out, or if you keep them, you make them profitable by extracting fees.
And this is the shift to the modern fee-based banking model.
Exactly. We hear about free checking all the time. Free checking is only free if you already have money. If you don't have a high enough balance, you suddenly get hit with monthly maintenance fees, minimum balance penalties, and the most lucrative one of all, overdraft fees.
The infamous $35 cup of coffee.
Baradaran notes in the text that overdraft fees became a primary massive revenue driver for these institutions. At one point, large banks were making more money from penalty fees on their poorest customers than they were from actual traditional lending in the consumer sector. They were literally generating billions of dollars in pure profit simply by penalizing people for running out of money.
It's incredibly perverse. It's like a hospital charging you an extra fee because you're bleeding too much on their floor.
But from a systems perspective, It is a design feature, not a bug. The system is entirely designed through this blind pursuit of scale and efficiency to shed low-profit customers. It's not an accident that Tanya gets squeezed out. It is the spreadsheet working exactly as it was intended to work.
So the big banks push the poor out through fees, and they literally close down the physical branches in low-income neighborhoods because they aren't efficient enough to keep open. What happens to the people left behind in those neighborhoods?
That brings us to the outcome section of the analysis, the creation of banking deserts, the void. But as we know from economics, the void does not stay empty. Tanya still desperately needs that $500 for her son's medical bills. Her demand for credit does not disappear just because the subsidized supply left down.
So the fringe banking sector moves in to fill that vacuum.
Exactly. Payday lenders, check cashing storefronts, auto title loan companies. And I was absolutely shocked by this statistic in the book, but it highlights the scale perfectly. There are more payday lender storefronts in the United States than there are McDonald's and Starbucks combined.
That is just staggering to think about. More than McDonald's and Starbucks combined. It really makes the sheer scale of the extraction visible.
It tells you that this is not some fringe niche issue affecting a tiny percentage of people. This is a massive multi-billion-dollar foundational industry. And we need to be very clear here about the author's stance. Baradaran argues that these fringe lenders are not operating illegally. They aren't loan sharks breaking legs in back alleys. They are totally legitimate, licensed businesses that are simply filling a desperate market demand that the heavily subsidized mainstream banks refuse to serve.
They're providing a service, but they are providing it at a massive, massive cost to the consumer.
The poverty premium. We mentioned earlier that Tanya ultimately paid $2,000 for a $500 loan. That is not an anomaly. The data shows that the average unbanked or underbanked family spends up to 10% of their entire household income just on transaction fees. That averages out to about $2,400 a year.
$2,400 a year just to use their own money.
Just to turn a paper paycheck into usable cash. Just to pay a utility bill through a third party. Just to buy a money order to pay rent because the landlord won't take cash and they don't have a checking account.
That $2,400, that is a family savings account. That is the emergency fund. That is the buffer against the next medical crisis or broken down car.
Exactly. The structure of the system effectively siphons off the exact capital that would allow these families to finally stabilize. It actively keeps them in a state of perpetual, incredibly stressful precarity.
And it creates the debt trap. I want to go back to that rollover concept we discussed with Tanya because I think a lot of people who haven't used a payday loan miss how predatory this specific mechanism really is.
This is the entire business model of fringe finance. If a payday lender lends you $300 and you actually pay it back in full in 2 weeks, along with $45 fee, they make a little bit of money. But honestly, it's a lot of administrative work for $45. They do not want you to pay off the principal.
They want you to fail to pay it back.
They want you to roll it over. Yeah. They want you to just pay the $45 penalty fee to extend the life of the loan for another 2 weeks. And then do it again next paycheck. And again, if you do that for an entire year, you have paid over 300 or 400% in annualized interest, and you still owe the original $300.
It's basically modern indentured servitude. You are working hours at your job just to pay the vig to the lender without ever reducing your actual debt.
And this brings us right back to that stark contrast between Tanya and Stephen, the distinction between illiquidity and insolvency.
The double standard at the heart of the system.
Right. The Federal Reserve stepped in to save Stephen because he was deemed too big to fail. They essentially looked at the mega banks and said, we absolutely cannot allow this insolvency to happen. It will ruin the economy. But for Tanya, the fringe banking system is structurally designed to create insolvency. It takes a very temporary manageable cash flow problem, simple illiquidity, and mathematically turns it into a permanent state of bankruptcy by piling on completely unpayable debt.
So we use unlimited public money to save the wealthiest banks from the consequences of the free market, but we use the absolute harshest version of the free market to crush the poorest citizens.
That is the structural reality of the American banking architecture.
It's heavy. It is genuinely enraging when you lay it out like that. But it also begs a massive question. Why does this persist? If the system is this visibly broken, this obviously extractive, why do we collectively allow it to continue?
This brings us to the persistence section of Baradaran's analysis. And it really comes down to the myths we collectively tell ourselves. the cultural narratives that maintain the status quo. And the biggest one, by far, is the myth of the free market.
Right, the idea that it's just business, it's supply and demand. If you don't like the 300% interest rate, just don't borrow the money.
Exactly. We comfort ourselves by saying that payday lending rates are simply the natural market price for lending to high-risk borrowers. But Baradaran's counterargument completely dismantles this. She points out that the market for money is not free. The mainstream banks, the competitors who could easily offer much lower humane rates to these people, are heavily subsidized by the public.
They are getting their money for almost free from the Fed, and their deposits are insured by the taxpayers.
Right. And her argument is simple. If the banks are subsidized by the public, meaning by all of us, including Tanya, who pays taxes, then those banks should have a reciprocal duty to serve the entire public. You cannot take the government safety net, the FDIC insurance, the Fed bailouts, and then suddenly claim free market rules when it comes time to serve the unprofitable poor. You can't have it both ways.
It is a fundamental breach of the social contract.
That is exactly the term she uses. Banks essentially receive the full faith and credit of the United States. In exchange for that unbelievable privilege, they are supposed to act as the financial machinery of the economy for everyone. When they systematically exclude 30 to 50% of the population, the unbanked and the underbanked, they are breaking that contract.
But they managed to get away with it year after year, largely because of another persistent myth, the myth of financial literacy.
Oh, this is the absolute favorite talking point of the banking lobby and policymakers. The narrative is, the poor just don't know how to manage their money. If we just gave them a high school class on balancing a checkbook and budgeting, they wouldn't have to go to payday lenders.
And it sounds so perfectly reasonable on the surface. Who could possibly be against financial education?
But it is incredibly patronizing and, frankly, it's gaslighting. Baradaran cites studies showing that the poor are actually incredibly savvy with their money. When you have very little margin for error, you know exactly where every single penny goes. You are hyper-aware of the price of milk. You know exactly what day the electric bill is due to avoid a shutoff.
Tanya didn't go to a payday lender because she suddenly forgot how to do math.
She went because the structural design of the economy gave her literally no other option to keep the lights on. She was trapped by systemic exclusion, not by a personal cognitive failure. Blaming her lack of financial literacy is just a highly effective way for society to shift the blame from the predatory design of the trap directly onto the person caught inside it.
So if we look at the whole board, we have a hybrid system that is designed to exclude, legally incentivized to exploit, subsidized by the very taxpayers it hurts, and justified by cultural myths. Is there actually a way out of this? Or are we just doomed to this bifurcated, two-tiered banking system forever?
Baradaran does offer a concrete solution. And what I find so fascinating about it is that it's not some radical, untested utopian invention. It's a pragmatic solution that is currently hiding in plain sight. It is a Hamiltonian solution to a Jeffersonian problem.
Postal banking.
Using the United States Postal Service to offer basic public banking services.
Okay, I have to pause you right there, because I think when you say the post office to the average American, they do not think financial salvation. They think of losing a package in the mail. They think of standing in a stagnant line for 45 minutes behind a guy trying to mail a car tire. They think of slow bureaucracy.
That is entirely the fair, knee-jerk cultural reaction we all have.
I mean, are we really suggesting that the exact same institution that struggles to deliver holiday cards on time should be trusted with managing the life savings of vulnerable people?
Yeah.
It just feels like we're trading private exploitation for public incompetence.
That is the most common critique, and Baradaran pushes back on it hard. She asks us to separate the current underfunded service levels of the post office from its actual structural infrastructure. And she points out a piece of history most people don't know. We actually did this before. Successfully.
We had postal banking in the U.S.
We did. From 1911 all the way to 1966, the United States ran a highly successful postal savings system. You could literally walk into your local post office, deposit your cash, and get a savings certificate backed directly by the U.S. government. It was incredibly popular, especially with newly arrived immigrants and the working poor, who understandably did not trust the volatile private commercial banks.
So why the post office? Why is the specific institution the proposed fix for Tanya's situation today?
It boils down to three massive structural advantages. First is geography. The physical brick-and-mortar buildings already exist. There is a post office in almost every single zip code in America.
Including all the banking deserts where Chase and Wells Fargo pulled out.
Exactly. In the hollowed-out rural towns, the post office is still there. In the low-income inner-city neighborhoods, the post office is still operating. The real estate is already paid for and maintained. You don't need to build thousands of new branches to reach the unbanked.
Okay, so the reach is already there. What is the second advantage?
Trust. Despite all the jokes about lost packages, polling consistently shows that the Postal Service is one of the most trusted public institutions in the country. It is familiar. For populations that feel intimidated or actively snubbed by the marble floors and security guards of a commercial megabank, the local post office is approachable. It is a shared civic space.
And the third reason?
The economics. This is the absolute killer app of postal banking. The post office does not need to deliver a massive quarterly profit to Wall Street shareholders. It just needs to break even to sustain its operations.
Explain how that changes the math for someone like Tanya.
A private payday lender charges 300% interest because they have high overhead, yes, and high default risk, yes. But primarily, they charge that much because they need to extract maximum profit to feed their investors. They are structurally extractive.
They need to feed the beast.
But the post office has no private investors. It can leverage the massive economies of scale of the federal government to offer small, short-term loans, say, that $500 Tanya needed at cost.
So instead of 300% interest, she pays what?
Maybe 10%, maybe 15%, just enough to mathematically cover the administrative costs and pool the risk of the inevitable defaults.
Which completely undercuts the predatory market.
It absolutely destroys the predatory market overnight. You wouldn't even need to pass complex laws banning payday lenders. You just offer a drastically better, fairer product, a public option for finance. If Tanya has a choice between paying a 300% rate at the Neon Strip Mall or a 15% rate at the federal post office, she goes to the post office every single time.
It provides a floor. It creates a baseline of decency that the private market have to compete with.
Exactly. And to be clear, this doesn't replace Chase or Bank of America for the middle class. If you want complex wealth management, airline rewards points, and a sophisticated app that tracks your stock portfolio, you still go to the private bank. But for the basic, essential utility of storing your wages safely and accessing small emergency credit, the post office ensures that nobody falls into the void.
It basically treats basic banking like a public utility, like water or electricity. We don't look at a poor neighborhood and say, well, it's not highly profitable to run water pipes to that part of town, so they can just buy bottled water at 1,000% markup.
We say water is a fundamental right for participating in society. And Baradaran is arguing, we need to start thinking of basic financial access in the exact same way, because without it, you are entirely locked out of the modern economy.
And this leads us perfectly into the interconnection section of our analysis, because this exclusion, it isn't just about Tanya losing a few $100s to fees. It is about massive generational ripple effects across society.
Right. Think about the single biggest generator of wealth for the American middle class over the entire 20th century.
Homeownership.
Homeownership. And who structurally enabled the 30-year mortgage market. The government, via Fannie Mae and Freddie Mac, working through the commercial banks. If you are unbanked or trapped in the fringe finance debt cycle, your credit is destroyed. You are permanently locked out of the housing market. You are locked out of capital accumulation. You are stuck paying ever-increasing rent to landlords who do have access to subsidized bank capital.
It creates a permanent structural caste system based on credit access.
And ultimately, Baradaran argues, it directly threatens democracy. This is why it's in the subtitle of the book. When a state-enabled, publicly subsidized banking system visibly serves only the wealthy and middle class, while actively extracting from the poor, the state itself begins to be viewed as fundamentally illegitimate by a massive portion of its citizens. It breeds deep cynicism. It breeds political instability.
And just on a purely practical level, you really cannot function as a full citizen in modern society without a bank account. You can't rent a decent apartment without a credit check. You can't get basic utilities turned on without massive cash deposits. And increasingly, you can't even get a legitimate job because employers demand direct deposit.
Financial exclusion is quite literally social and civic exclusion. You are relegated to being a second-class citizen in your own economy.
So, we have walked through the historical design of the hybrid system, the incentives driving consolidation, the devastating outcomes for the marginalized, the myths that allow it to persist, and a historical solution that could actually reconnect the system to the public good. It is a massive amount to process. But as we wrap up, I want to bring it back to the core operational theme of our show. Expert, I have to ask you directly. What is the crisis in perception here?
The crisis in perception is that we culturally view banking as a neutral, private, free marketplace where success is determined by personal responsibility and failure is determined by personal risk. We look at the unbanked and we perceive it as a niche behavioral problem of the poor. We see it as a failure of individuals like Tanya to adequately manage their chaotic lives.
We see Tanya's failure as Tanya's individual fault, and conversely, we see Stephen's massive institutional success as Stephen's individual genius.
Exactly. But the structural reality, the layer that is intentionally obscured from us, is that the entire American banking sector is essentially a state-subsidized public utility that is legally permitted to act as a private wealth extraction machine. We obscure the reality that we, the taxpaying public, are the ultimate insurers and the lenders of last resort to these massive institutions. We are the miracle lender that saved Stephen. Yet we casually allow these exact same state-backed institutions to deny basic service to the most vulnerable among us.
We have fundamentally forgotten who actually underwrites the risk of the entire system.
We have obscured the social contract. We have accepted a distorted reality where banks exist solely to maximize returns for their shareholders, and we have forgotten that, by historical design and by law, they exist to serve the productive economy as a whole.
It really does force you to look at that brick-and-mortar building on the corner completely differently. It's not just another private retail business. It is a critical piece of public infrastructure that we have somehow allowed to be entirely privatized for profit.
And until we collectively recognize that, until we learn to see the massive public subsidy operating just underneath that corporate logo, we are going to keep blaming Tanya for a systemic problem that Stephen designed.
So, leaving our listeners with a final thought, what does this structural clarity actually mean for us moving forward?
It means we need to recognize that access to basic, non-predatory credit is a prerequisite for economic mobility. You cannot pull yourself up by your bootstraps if you don't even have boots. And in a modern capitalist economy, affordable credit is the boots. Without it, the so-called American dream is not just difficult, it is structurally mathematically impossible for the bottom half of the country.
Crisis in Perception examines how systems shape belief and how better tools help us see clearly.
They absolutely do.
This project is free and publicly accessible. If you'd like to support the time, tools, and research behind Crisis in Perception, you can become a supporter on Patreon.
And for a shorter visual overview of this topic, see the mini explainer linked in the description.
If you enjoy this kind of systems-level analysis, please like, subscribe, and comment with books or topics you'd like us to explore next.